So, when you look at a company's books, right, you see the obvious stuff. Its debts, its loans, but what about all the promises it makes for the future? Those hidden obligations? That's where the real story is. And understanding them is the only way to see what's truly going on. To do that, we've got to ask a really basic question.
And that really gets to the heart of it. What does a company truly owe? It's not just the money it borrowed. Nope. It's about every single commitment it has made, big or small, that it will have to make good on someday. And that's where things start to get really, really interesting. So, how do we even start to answer that? Well, it all begins with this idea of contingencies. This is basically the accountant's playbook for dealing with the great unknown, all those potential what ifs that could cost the company money down the road. It is all about trying to manage future uncertainty.
The official definition is kind of interesting because a contingency isn't just some vague worry about the future. It's an existing condition. The wheels are already in motion. Think about a lawsuit that's been filed or a product that might need to be recalled. The situation is here now, but the financial hit, that's still a big question mark. So, the big question is, how do you actually put a number on a what if? I mean, whether we're talking about a massive lawsuit or just the chance that your brand new phone might break, there's a really clear set of rules for this. Let's break down how that framework is built. So, accountants have this three-tiered system they use. They ask, is the potential loss probable? Is it reasonably possible? Or is it just remote? And here's the absolute key. A company only records an actual liability on its main financial statements if two things are true. The loss has to be probable, and they have to be able to reasonably estimate the amount. If it doesn't meet both those tests, it might just get a mention in the fine print.
We actually see this principle at work all the time. Probably the most common, easiest to understand example of a loss contingency is just a simple product warranty. If you sell something, you're making a promise to fix it if it breaks. And that promise? It has a cost. But, and this is super important, not all warranties are the same. You've got your assurance type warranty, which is that basic guarantee that the thing you bought isn't a dud. It's just part of the deal. Then you have the service type warranty. That's the extra you pay for, like an extended protection plan. One is a potential cost the company has to plan for, and the other? That's a whole new sale, a completely separate stream of revenue. Okay, let's just walk through a really quick example of a standard assurance type warranty. This company figures that future repairs are going to cost about 8% of whatever they sell. So in year one, they sell $300,000 worth of stuff, which means they calculate a total future expense of $24,000. Now here's the wild part. Even though they only spent $5,000 on actual repairs that year, they have to account for the entire estimated future cost right away. Yeah, so this is the crucial point, right? With those $300,000 in sales, the company must book the entire $24,000 estimated expense in year one. It doesn't matter that the actual repairs are going to happen over the next 2 years. The rules force them to be upfront and recognize that full obligation the second they make the sale. All right, let's shift gears. The next huge area of these hidden promises, it's leases. We usually think of a lease as just renting, right? But sometimes, especially with long-term leases, it starts to look and feel a lot more like you're actually buying the thing. And how accountants handle that difference can totally change how we see a company. And that's the million-dollar question, isn't it? How can you tell if that 10-year lease for a fleet of trucks is just a rental, or if the company has pretty much bought them? The answer to that question decides whether a gigantic asset and a gigantic liability suddenly appears on their books. So how do they decide? Well, there's this 5-point checklist. And if a lease agreement checks just one of these boxes, just one, it's no longer considered a simple rental, what they call an operating lease. It gets upgraded to a finance lease, and it's treated on the books as if the company bought the asset and took out a loan for it. Okay, so with the new rules, things get a little tricky. But the main idea is that both types of leases now require a company to put a right-of-use asset and a lease liability right there on its balance sheet. So the good news is the obligation is now visible either way. The real difference, though, is in how these leases affect a company's profits and cash flow over time.
And this is where you really see the difference. A finance lease gets broken up into interest and amortization, which can make the company look like it has more debt expense up front. An operating lease, on the other hand, just shows up as one single, steady lease expense. This totally changes key financial ratios, and it tells a very different story about how the company is structured and how it operates.
Okay, for our last topic, let's dive into what might be one of the most confusing things in all of accounting: taxes. Have you ever wondered how a company can report a massive profit to its investors, but then turn around and tell the tax authorities something completely different? Well, it's not sketchy, it's perfectly legal, and it's all about timing. You know, this whole thing really just boils down to one idea: a temporary difference. It happens simply because the rules for financial reporting are different from the tax rules. Financial reporting rules are designed to give investors a smooth, accurate picture of performance over time. Tax rules? They're just designed to collect revenue. As a result, they often recognize income and expenses in totally different years. So what happens because of these timing differences? Well, you get one of two results. A deferred tax liability basically means you got a tax break now, but you're going to have to pay more tax later. It's a future obligation. A deferred tax asset is the opposite. It means you paid more tax now than you really needed to, which creates a future tax benefit, kind of like a credit you can use to lower your taxes down the road. So after wading through all that, contingencies, leases, deferred taxes, it all comes back to one big idea. Understanding a company's liabilities isn't just about adding up its debts. It's about reading the story the company's telling, the story about its future promises, obligations, and its risks.
Because in the end, it really is this simple. Liabilities are not just numbers on a spreadsheet. They are the financial footprint of every promise a company has made, to its customers, to its landlords, even to the government.
Okay, so what are the big takeaways here? What do you really need to remember? First, that liabilities are promises. Second, that all these rules for things like warranties and leases are there to force companies to be honest about their future risks. And third, those weird deferred tax items on the balance sheet, they're a roadmap for how much cash a company will have to pay in taxes later on.
So I'm going to leave you with this challenge. Now that you know where to look, in those warranty estimates, the fine print on the leases, and those deferred tax footnotes, the next time you pull up a company's financial report, what hidden promises are you going to find?